So you're in your 40s or maybe your 50s, you've just discovered dividend investing, and your literal first thought is probably something like, man, I waited way too long. The folks making the actual money from this started when they were 25 and I completely missed the boat. Well, welcome to this explainer. We're going to look at exactly why that belief is frankly completely wrong. Today, we're digging into the real numbers and the exact 2026 math you absolutely need to generate actual real-world retirement income.
Let's just address the elephant in the room right off the bat. Are you too late to start? The math emphatically dismantles this belief completely. Absolutely not. No way. You see, you do not need a 25-year-old's 3-decade timeline to make dividend investing work. You just need the right 2026 math and a strategy that is built from the ground up for faster results. The whole finance world is completely obsessed with 25-year-olds maxing out their accounts, but we're going to focus on a totally different, much more powerful path for those of us starting just a little bit later.
Okay, let's dive into this. Here is our agenda for today. We'll start with the late starter myth, then move into the yield sweet spot, accumulate then activate, building your asset engine, running the real math, and finally, your dividend freedom number.
Section 1. The late starter myth. Let's get right into it.
Before we even think about building your portfolio, we absolutely have to talk about the #1 critical mistake late starters make right out of the gate when they're trying to catch up on lost time. Most people starting in their 40s or 50s just panic, and they fall right into the trap on the left. They start chasing these wild 10, 11, 12% yields. They think, hey, I've found a shortcut. And yeah, the logic kind of makes sense on the surface. Higher yield means more income, faster, right? But here is the harsh reality. Many of these ultra-high yield stocks are paying out literally way more money than they even earn. The payout ratio is totally unsustainable. And when that company inevitably cuts its dividend, well, you lose your income and the share price tanks at the exact same time. It is a massive double hit. As a late starter, you simply don't have 10 years to sit around and recover from a bad bet like that. But now, look over at the right side. This is the real alternative, targeting 4 to 8% yields with a really consistent 5 to 10% annual dividend growth.
Which brings us to Section 2, the yield sweet spot.
Now, what's really interesting about this slide is this is the middle ground that almost nobody talks about. It's where you get the income you need right now, but also the growth you're going to need later. Let's walk through this absolutely magical concept of yield on cost. Let's say you invest in a stock paying a super moderate, totally safe 6% yield today, and that company grows its dividend by 7% every single year. In 10 years, the yield on your original investment, it's not 6% anymore. Because of that consistent compounding growth, it transforms into a massive effective yield of over 11%. You've essentially built a high-yield asset without ever once taking on the dangerous risk of those trap stocks we just talked about. I mean, this is the secret weapon for every serious late-start investor.
Let's contrast the mainstream finance advice with the reality of your actual advantage as an older investor. See, when you're 25, you have the luxury of using that strategy on the left, buying low-yield, high-growth stocks and just waiting 30 years for them to compound. Must be nice, right? But when you're 45 or 52, you obviously don't have 30 years to just sit around and wait. You need the strategy on the right. You need to target yield and growth simultaneously, compressing that timeline down to a 5 to 10-year window. This yield growth sweet spot gives you exactly that. It's so absolutely crucial to realize this isn't some sort of compromise. It's actually a far smarter, much more efficient strategy tailored specifically to your exact timeline.
All right, Section 3. Accumulate, then activate. Even if you totally understand the sweet spot we just covered, if you don't use this next reinvestment structure, you are leaving just massive amounts of money on the table. This is the single most powerful move that almost all late starters skip right past. It's called the phase-based drip strategy, or accumulate then activate. Here's how the whole concept works. While you're in the accumulation phase, meaning you're still working your day job, you've got your normal salary, and you don't actually need to live off the dividend income quite yet, you reinvest every single dollar of your dividends right back into buying more shares. It creates this crazy compounding loop. Every quarter, your dividends buy more shares, which pay more dividends, which buy even more shares. But instead of just leaving that on autopilot forever, you set a specific target date. Maybe it's 5 years from now, or when your portfolio hits a certain number. On that date, you flip the switch, you stop reinvesting, and you activate the cash as actual usable income. It works beautifully because you only need strict financial discipline for 5 to 10 years rather than 30.
And this brilliantly illustrates just how violent the math is in the absolute best way possible. Let's look at a $150,000 portfolio that's averaging a 6% yield. That generates $9,000 a year, or about $750 a month. Look at bar 1. If you just spend that $750 every month, in 10 years, you still just have your original $150,000 invested. But check out bar 2. If you automatically reinvest that $750 a month for those 10 years, and the portfolio grows even modestly, you're suddenly looking at a total value closer to $280,000 or even $300,000. I mean, that is nearly double. So when you finally decide to flip the switch and activate your income, you aren't just pulling $750 a month anymore, you're pulling $1,400 to $1,500 a month from that exact same 6% yield.
Next up, Section 4, Building Your Asset Engine.
All right, it's time to shift gears from the mathematical theory to the exact 2026 asset mix you need to actually execute this safely in the real-world market. The first asset category? Dividend ETFs. If you want true diversification without the massive headache of managing 40 different individual stocks, ETFs are your absolute foundation. But you want to blend two specific types here. First, you've got your engines, dividend aristocrats and kings. These are companies with literally decades of raising their dividends. They might have a lower starting yield, maybe 2 to 4%, but they provide massive 6 to 10% annual dividend growth. Second, you have your income accelerators. These are funds focused on covered calls or preferred shares, and they're yielding a very nice 6 to 8% right now. The key here is balance. You don't want to go all in on just one side. By balancing the low-yield growth engines with the higher-yield accelerators, you hit your income targets faster while also making sure your portfolio thrives in year 3 and year 15.
Next up, we have a category that most mainstream content totally ignores, honestly because it just isn't flashy. I'm talking about BDCs, or business development companies. These are strictly regulated companies that lend money out to small and mid-sized businesses. And by law, they are actually required to distribute at least 90% of their taxable income right back to shareholders as dividends. That legal requirement is exactly what creates those fat yields we see, often sitting right between 8 and 11%. So the crucial point here is this. You absolutely must look for a BDC with a dividend coverage ratio above 1.0. That simply means they are bringing in more than they're paying out. When you verify that ratio, allocating about 15 to 25% of your portfolio here acts as a massive income accelerator rather than some reckless gamble.
The third and final category is individual stocks, specifically what we call the core 4 sectors: utilities, consumer staples, healthcare, and financials. Now, why these 4? Well, because people are always going to need electricity and water, food and cleaning products, medicine, and banking. It completely does not matter whether the economy is booming or we're in a deep recession. Now, I get it, owning 8 to 12 stocks spread across these 4 sectors, it's probably not going to make you the most exciting person at a dinner party, but these sectors provide the absolute most reliable, consistent, sleep-at-night foundation for a late starter portfolio.
Moving right along to Section 5, Running the Real Math.
Okay, this is where the rubber meets the road. Let's move to and see how this builds, transitioning from theory into 3 real-world mathematical scenarios based on realistic 2026 market expectations. We're looking at a 10-year build using a historically conservative 7% growth rate and a 6% blended yield. Look at row 1 right there. Starting with $50,000 and adding just $500 a month gets you up to around $190,000 in a decade. That's about $900 a month in pure dividend income. That's enough to completely cover a car loan and your groceries without ever touching the principal. Stepping up to row 2, if you can start with $150,000 and add $1,000 monthly, you are suddenly looking at nearly $500,000, creating over $2,300 a month in dividends. You combine that with Social Security, that is incredibly livable. And if you're already sitting on $300,000, like in row 3, even with very minimal additions, you can push past $800,000. That yields roughly $4,000 a month. Guys, that is a full retirement. The big takeaway here is that whether you need a $900 supplement or a $4,000 total replacement, the math genuinely works at every single level.
And finally, Section 6, your dividend freedom number.
It is time to empower yourself. We need to stop relying on these vague hopes of being comfortable one day and instead calculate the exact, tangible target you are actively building toward. Here is a super simple but absolutely profound framework so you can reverse engineer your required monthly contributions right now. Step 1. Determine your target monthly expenses, basically the monthly income you want to generate in retirement. Step 2. Take that exact monthly number and just multiply it by 200. The result you get? That is your target portfolio size. It really is that fast and that straightforward to figure out exactly what you are aiming for.
Let's run a really quick example just to illustrate how much clarity this brings. Let's say you sit down and decide, okay, I need $3,000 a month for my dividends to live comfortably or maybe supplement my other income. You take that $3,000, you multiply it by 200, and boom, you get $600,000. That $600,000 is your precise dividend freedom number. Why? Because if you have a $600,000 portfolio generating a 6% yield, it throws off exactly $36,000 a year, which of course breaks out to exactly your target, $3,000 a month.
You know, there's a really great saying out there. The difference between people who build dividend income and people who just watch content about it is that one group has a number and the other group just has a feeling. Listen, starting in your 40s or 50s is not some huge disadvantage. Actually, scratch that. It's a unique advantage. You're very likely in your peak earning years right now. You have a steady income, you have total clarity about what you actually want your life to look like, and most importantly, you have urgency. That is something 25-year-olds just do not have. You just need to sit down, do the math, and write down your real number.
So I'm leaving you with this provocative final thought today. What is your number? I really want you to calculate your own dividend freedom number right now. Seriously, please don't wait. Run this simple math, figure out your precise target, and then share your current situation and your number down in the comments for us. Are you just getting started? Are you maybe trying to optimize an existing portfolio to get a better yield? Let's talk about it below. Thanks so much for joining me on this explainer. Remember, the folks who told you it was too late, they were just using the wrong math. You have the right math now. Go build something.